Okay. So let's do it as per the requirement of the question. So in the books of Osei Bones, A, we are supposed to prepare the debtors account. So I'm sure you're also ruling your T account for the debtors account. Don't watch me while I do it, you to do it alone.
So please, me, I can't do it because it's light out here.
When you're kafra, it. Okay, so the debtors account. So like we have been doing for the past days, you know the items that you need to prepare your debtors account. The first thing is any opening balance. And again, you start from the first year. And the first year is 20x7 or 2007, if you want to put it. Okay, so let's begin. We first look for the opening balance or the balance brought down before we look at credit sales, bad debt, cash received. I hope you don't or you haven't forgotten the format. Okay. So
Yes.
yeah, so for this year, 2007, was there any opening balances? So check for me. Let's see. It says a seller of cars spare parts started business on 1st January 20x7. Okay, so he started the business even in 2007. Okay, according to his records, provision for bad debt is fixed. The debtors schedule showed the following. Now look at it, year to 31st December. So it means that these balances are to 31st December. So this 8,950 is as at 31st December, which is the closing balance. So there is no opening balance for 2007. In other words, as at 1st January 2007, there was no balance on debtors, as shown in this question. So there's no opening balance for 2007. But let's check other information we have for 2007. So we have established this as the closing balance or the balance carried down. This is the bad debt for 2007. And then when you receive check received from credit customers and cash discount allowed in 2007, totaled this and this. Okay. So if you follow what we are doing, you can determine that for 2007, we have some information we can use to prepare the debtors account. One of them is cash received from customers. The other is discount allowed. And then we also have the bad debt and then the 8,950, which is the balance on the debtors account at the end of the year, which is the closing balance. Okay, so let's do that and see what happens. So let's look at how that goes in. Okay, so since we have, let me put that data here, 2007. From the question we have bad debt of 950. We also have, they said check, so check from customers. That check was 16,980. Then we also have discount allowed. Which is 3,280.
Say.
Yeah.
Please, the
Bad debt. This thing. Sorry. I've not seen it so.
The bad debt what?
Yeah, please, you see, I was watching the debtors including bad debt. That one is 8950. I
Yes.
thought you forgot.
So yeah, that one is the closing balance. As you see, it says the debtors schedule show the following to 31st December. So these balances are closing balances for the debtors figure, right? But they are giving us some
Yes.
extra information. They are saying this amount includes bad debts. It includes bad debt. So what it means is that they have not deducted the bad debt from it. Okay, and your closing balance on debtors should always be less bad debt. You shouldn't have bad debt. So let's look at how we go about it. Okay. So we have this data. Which one do we put in first? I think we can put in the bad debt. And which side would bad debt be? Debit or credit?
So please, to increase the debtors balance, so you debit.
Bad debt will increase the debtors balance. Are you sure about that?
Bad debt. It's Calibre the talk.
Caleb.
Yeah.
Bad debt, does it increase
Sure.
debtors balance or decrease it?
Please, bad debt. Decrease it.
It will decrease it. So bad debt should be at the credit side. Okay. What date would we use? We use the closing date, 31st December 2007 or 2007. The figure is 950. Okay, after the bad debt, the next one is the check received from the debtors. And check received from debtors, would it increase or decrease it? It is going to decrease, yeah. So we put that one too at the credit side, a check received. 16,980. Okay. So, and then discount allowed. Discount allowed will also decrease it. So we put it here. $3,280. Okay, so we have exhausted these three information. What is left is the closing balance, which is the balance carried down. It is balance carried down because of the information that the debtors schedule show the following information. So debtors including bad debt. So that's the balance carried down. And this one is simple logic. If the balance brought down of debtors is at the debit side because they have a debit balance, then the carried down will always be at the credit. So 31st December 20x7. Balance carried down. Now this is where you have to pay attention to. They are telling us that this 8,950, it includes bad debt. Okay, and you can't carry down your debtors balance with bad debt included. So it means we have to less it from it. So in essence, what it means is that the closing balance is actually what? 8,000, but we have to less the bad debt 950 from it. Okay. That is the essence of that information given, that including bad debt. Okay. So we have put in the information. Let's balance it and see. So I think 950 plus 16, 980 plus this, plus this. We have 29,210. Please pay attention. You see that the difference will be at the debit side, which is 29,210. The question is, what name do you give it to this figure? Let me find out for you before I tell you. What name would we give to that figure? 29,210. Should we call it balance carried down?
No.
No, because already we have our balance carried down. So if it happens that way, then you can attribute this amount to credit sales. To credit sales. Okay. So 31st December 2007. Credit sales. Now, as we go forward, I would clear some of the confusion with it right now, but this is what you have to pay attention to. If you are preparing the debtors account and you are given certain items, then any difference you have on either the debit or credit side, you can attribute it to those items you were not given. So in this question, they didn't give us credit sales for 2007. Right? They didn't give us credit sales for 2007. But after putting in the information given us, we realize a difference at the debit side. There's nothing else you can attribute to than credit sales. So pay attention. It's common with the debtors account when you are solving questions around it. I think Ken's network has taken him off. I hope he can come back. Okay, so yes, Caleb.
Please, I don't understand why the credit side, at least in the debtors, including bad debt, was carried down at the credit side of the debtors account.
Okay. So I think I have to take you back to the. Let me go and bring the debtors account back. Okay. So Caleb, this was the debtors account that we saw the last time. Here. Right?
Yes.
Good.
Yes.
Now the balance brought down is the opening balance, and the balance carried down is what? The closing balance. So in the illustration that we just saw, let me copy this to the other page so that we can do the comparison there. I wish Ken was around. So let's do the comparison here. So you realize that in the illustration we are solving, we're given bad debt, right? So we have credited it. We're given check received, we have credited it. We're given discount what? Allowed, we have credited it. And again, they give us the balance carried down, which is the closing balance. So let me go back to the question so that you can figure it out. It says the debtors schedule showed the following information year to 31st December. So this 8,950 you are seeing is as at 31st December of that year, 2007. So that is a closing balance or a balance carried down, because carried down is the closing balance.
Yes.
Okay, now they are telling us that that figure includes bad debt. And I'm saying in accounting, when you end the year, your bad debt should not include, your debtors balance should not include bad debt. So when you end the year, you have to less. That's why you remember in the balance sheet, if there is bad debt in the question, in the balance sheet, you bring your debtors figure and then you less bad debt. So it means that at the end of the year, if bad debt is included in the debtors balance, you have to less it from. Even before you calculate your provision, that's 5%, 10%. If there is bad debt included in your debtors, you have to less it always before you apply the rate. So that is why we have less than 950 from the 8,950 to get 8,000 as the true closing balance of debtors figure. So after putting in, you realize that when you balance it, the difference is at the debit side, right? Now this debit side could either be the opening balance or bad debt recovered or the Sunday check. And I'm telling you, looking at the figure, the best missing puzzle is the credit sales. It cannot be the opening balance because the question would have given you opening balance if there is. Okay, having said that, let me quickly add on that sometimes you can have credit sales, you can have the returning was bad debt discount allowed, and maybe when you balance the account, the difference will be here, and that will represent the cash or check received. So it can happen that way.
Okay.
But the two key items that may be missing are on the debit side is credit sales, and then on the credit side is the cash or check received. These are the two items that sometimes they omit. So as you balance your account and you already have your closing balance, any difference can be attributed to credit sales on the debit side or cash or check received on the credit side. So I want to believe you're okay.
Yes, please.
Good. So let's bring down this balance. So the carry down for 2017 will come down 1st January 20x8 as the balance brought down, which is 8,000. Okay, then we go into 2008 and also pick the information like bad debt, credit, those information we can use to prepare the account for 2008. So let's read. If we read, I think we have the closing balance for 2008 as well as the bad debt for 2008. And when we go to, we're given that cash sales amounted to 26,000 and credit sales amounted to 15,000 in 2008. Okay. Now these ones are in 2009. So 2008, the information we have is we have bad debt here, 1,006. We have the closing balance, that's the balance on 31st December, but it includes the bad debt. Okay, fine. And they are telling us they have some cash sales and credit sales. Okay, so let's pick that data for 2008, or let's put them in straight away. So as we know, the bad debt 1,006 will come in here. So 31st December 2008. Bad debt, that one we don't have to waste time with it. We know what to do with it. And this is the closing balance. So that's the last thing you record in your account. Always the carry down should be the last thing. Now let's come to this side. We have cash sales. Cash sales. We sold goods and we took cash. Are we supposed to record it in the debtors account?
Sir, please. We sold goods and took cash. Yeah.
Yeah,
Yes.
cash sales. So does it affect debtors?
Yes.
How? Explain to me. So let's take for instance, I'm a business and you are my debtor. You owe me 100 cedis, right? And then I sell goods to you 50 cedis and I take my cash. Would that increase your balance or decrease it?
Sir, please pardon me.
Should I take the example all over again?
Yes, please.
Okay, so you owe me, you are my debtor. You owe me 100 cedis, eh? And then I sell goods to you. So cash sales, I sell goods to you and I take my money. For example, I sold 50 cedis. goods to you and I took cash, or you paid me the 50 cedis. So that cash sales for 50 cedis, would it increase the debt you owe me already, or is going to? So it will have no impact, right?
Yes.
So cash sales is not an item that is recorded in the debtor's account because it will not increase it or decrease it. So it's just here to disrupt you. So we pick the next item, which is the credit sales. So as we know, credit sales will affect. We'll come back. So the credit sales is 15,000. Okay. And then the last thing left will be the closing balance. And the closing balance is 12,600. It includes bad debt, so we have to less the bad debt from it. So that will be 11,000. So 31st December 20x8. Balance carry down 11,000. Yeah, Caleb.
Sure. Please, you see the first one. It was the credit sales amounted to 26,000. So please, why didn't you use that one?
It was cash sales, and cash sales. That was the point I was explaining to Caleb. Cash it doesn't increase your debtor's balance or decrease it. Example, obi de oka 100 cedis. Okay, and wasan akoton ade ama no 50 cedis, but oji wo sika. It is our cash sales of 50 cedis. So cash sales does not appear in the debtors account because it doesn't have any impact on debtors.
Okay.
Good. Now, I was trying to do some gymnastics here, but I think I need to let you follow. So 31st December 20x8. Balance carry down. So 11,000. And Kenneth, another point we made was that anytime you see debtors, including bad debt, okay, it should tell you that at the end of the year, you have to less that bad debt from it because your closing balance on debtors should not have bad debt included in it. That is why here, the 12,600, we are removing the bad debt which is included in it so that we have the true closing balance, 11,000. Okay, so I think the session is ending. Aka 1 minute. And when it ends, let's use the second session details. Say more a official accounting page. So you have those first session, second session details. Right, Caleb? Okay, no problem. Let's rejoin after 10 minutes, and then we'll continue.
So please, do you have it?
Yeah, let's rejoin after 10 minutes. Okay, so bye.
Okay.